Welcome, classes in session again here in Lecture Hall Room 101 of the Stately Apartment Academy, which is the multifamily industry's only operations-focused podcast featuring insights from industry leaders, investors, vendors, and technology providers. So if you invest in multifamily real estate or you're involved in the day-to-day on-site operations of apartment buildings, we're your source for efficient operations and maximizing your NOI. Today we're doing something a little different. We're just going to talk with just me, Professor Cunningham, about financials and how to read property financials and how to interpret property financials. And really we're going to start with the basics and give you a ground up understanding of how property financials are interpreted by asset managers and owners and investors. So let's go ahead and jump right in. Okay, so let's start off just high level with the various components of an income statement. First of all, there are three financial statements that you will contend with in property management and every other business for that matter. But you have your income statement, a cash flow statement, and then you have a balance sheet. We're going to talk a lot, mostly about the income statement, but we want to talk a little about the implications of cash flow and the balance sheets as well. But on an income statement, which is what most people think of when they think of how is my property doing, first of all, you have revenue. Revenue starts with gross market rent. You subtract from that loss to lease to get to gross potential rent. From gross potential rent, you're going to subtract your vacancy losses and concessions. That gets you to scheduled rent. We're going to talk about all these definitions here in a second. So from scheduled rent, you're going to subtract your expenses. You have controllable expenses. You have fixed expenses. Once you subtract your expenses, you get to net operating income. Okay. From net operating income to get to actual income or free cash flow, first of all, you're going to subtract debt service. You're going to subtract ownership expenses, and that gets you kind of to net cash flow. From that, you're going to subtract depreciation and amortization, which usually gets you to your net income, net loss number. And then from that, you're going to subtract capital expenses, any other random cash items, and then that will get you to free cash flow. Okay. And free cash flow is sort of like your taxable number, right? That's going to be ended up reported to the IRS. So there's a lot between net cash flow, which is very close to the actual cash that you will take home on a monthly basis, and free cash flow. So there's a big difference there. But that's generally the outline of your income statement. Now let's talk about each one of these items separately. Okay, so let's start with gross market rent. Gross market rent is the highest monthly rent that an individual unit can command in its competitive market. And so that means if you were to lease a unit today, what is the highest nominal value you could achieve for that unit? It is going to be different than probably what the unit's achieving right now. And we'll talk about that in a second. And gross market rent is, it's sort of a judgment call. It's not a hard and fast number. It's your best guess as to what that unit is worth. What kind of rent can you command for that unit? Given your understanding of the competitive market and how your features and finishes compares to the property next door, how your amenities influence pricing compared to the property down the street. So gross market rent is a little bit of a fuzzy number. If you're an honest owner and investor, you will try to set that gross market rent as close to what you believe it to be as possible so that you can gauge somewhat your potential upside in that property. How much more money can you be making from that property if as units roll, as they turn, what is the likely trajectory of the income at that property? If you're trying to sell the property or you're buying a property, gross market rent might be something a little optimistic because if you're a seller, you might want to entice your buyer that, your units are worth far more than what you're achieving right now. I'm a terrible manager. I'm super conservative. I never push rents. These units can all earn way much more than I'm earning right now. I care more about being 99.9% occupied than I do about rent. Those are all stories the seller tells you to get you, to entice you to buy a property under the auspices that you can make more money. So as a buyer, you immediately want to discount whatever gross market rent numbers is in their rent roll. You need to make your own judgment. You look at the comps and do your own study. There has been, over the course of the last 10 years, there have been great advances made in revenue management software that allows you to do two things. Number one, take some of the guesswork out of gross market rent. Revenue management software still relies on looking at what the market will bear and comparing against comps. That's still part of the equation. Revenue management software will take advantage of upcoming vacancies. It will take advantage of of what market vacancies will be. And shortages either at your property or in the market in general, to push up that market rent when it sees an opportunity to do that. And revenue management software providers will tell you that the difference between a property that has a revenue management software in place and one that doesn't can be as much as 10% in terms of rent. And I believe that, for sure. In fact, I don't have to believe it. I think that's been proven without a shadow of a doubt. So if you're an institutional class owner, which is to say you have a property with 50 units, 100 units or more, and you're not using revenue management software, you're probably leaving money on the table. Anyway, so that's gross market rent. Best guess at what what the total rent would be if every unit at that property were rented at its highest possible rental rate. But you have gross potential rent. Gross potential rent is the maximum possible monthly rent, given that some of your units are leased at a lower rate, and if every vacant unit that you have were leased suddenly at its individual market rent. So that's your gross potential rent. What you could make today, if you suddenly leased everything, and given what your in-place rents are, which is often usually called your loss to lease. So for every unit that is renting for something below the market rent, that's called your loss to lease. And that represents your gross potential rent. Your scheduled rent is the actual rent you expect to be collected that takes into account vacancies, first of all. So you subtract that from your gross potential rent. And if you're offering any concessions. And concessions can be, let me say, the actual concession, which means that you're giving somebody 1 month free, and this is the month you're giving them free. So you're going to subtract that month from your gross potential rent. Or it can be an amortized concession, whereas you're giving them 1 month free, but you are amortizing that 1 month over the year. So they're getting 1/12 of that month every month. Or it can be an accrual allocation of a concession, which means maybe they're getting the entire concession this month, but you're following accrual accounting principles, which you're actually taking that concession and you're spreading it out over 12 months, even though, all of it is being actually taken in this month. So, whatever one of those formats you're following, you subtract concession, loss to lease from gross potential rent, and you get to scheduled rent. So scheduled rent is more or less all of the rent that you should expect to collect every month, and you can consider that to be your revenue number. So now let's talk about the expense side. So I mentioned you have controllable and you have fixed expenses. Controllable expenses, as you might imagine, are expenses that the property management company has some influence in setting. So expenses such as maintenance, payroll, advertising, these are considered controllable expenses because the property management company decides how much to spend every month on those costs. The other side are fixed, non-controllable expenses. Those are essentially insurance and taxes. Managers don't have any say in those numbers. They're set annually and they generally remain fixed for a 12-month period. So those are the two broad definitions of expenses that you need to know. So now we get to income. If you take your scheduled rent and you subtract from it your controllable expenses, your fixed expenses, then you get to what is known as net operating income. And NOI, net operating income, is a special number. It is not income, despite what it might say. It is not the actual money that's going into your pocket every month. And I will describe that more in a little bit here. But nonetheless, NOI influences a number of very important metrics. One of them is your debt service coverage ratio, sometimes called DSCR for short. And a DSCR is a ratio of your NOI to your monthly debt payment. And this is important to lenders. They will want to see a ratio of at least 1.10, sometimes 1.15, sometimes 1.2, rarely more than that unless you've got something odd going on. But in other words, you need to have, your NOI needs to be 10 to 20% more than what your debt coverage, than what your debt payment is, so that the bank, the lender, has a level of comfort that even if you have a bad month and you have some people move out, you have some vacancies, you can still make the debt payment, right? Which is really important to them. When you buy a property, when you're going to acquire a property, you have to project what your NOI is going to be. You're going to have to project what your DSCR is going to be. There's a lot of really interesting hijinks that go on here when you're buying a value add property and you're trying to convince a bank that you're going to be able to raise rents such that eventually the rents will meet the rents will be able to produce an NOI that meets their minimum DSCR. Often your value add properties, which are properties that you buy because you believe there is upside. Oftentimes those properties are purchased at a price that does not cover the DSCR, but you present a plan to the lender that shows that your market rents are a certain amount above where your current rents are, and that you can, by adding stainless steel appliances or, brand new orange shag carpet, that you can increase the amount of rent over time and achieve an NOI that will provide a proper DSCR, a satisfactory DSCR to the bank. And so there are a number of ways, and we'll get into this, that the bank will allow you to bridge that time period. They'll have reserves. There's some other things. But nonetheless, the point is NOI is a key number from a financial institution's perspective as to how that property is performing and how much debt that property can support. If your NOI falls below a certain DSCR, oftentimes a number of really bad covenants that are in the loan can kick in. For example, you may have to take all your rents that you collect, and they may have to go to a lockbox that the bank controls so that they pay themselves first. And then they will then give you money to pay expenses. So monitoring NOI and understanding what's happening with NOI is very important. Okay. So, as I said, NOI is not income. It is not necessarily the money that you're putting in your pocket. And I'll explain why. One of the most important things that's missing from NOI, which we just talked about, is your debt service expense. So NOI is exclusive of the payments that you make, on whatever loan you have. If you own a property in cash, NOI can be very close to your net cash flow. So if you have no debt, then NOI sometimes is the same as your net cash flow, but usually you've got some debt service piece. And there may be other ownership expenses that come out of NOI before you get to what's called net cash flow. So there might be asset management fees that you have to pay, either to partners, other owners, taxes, these sorts of things. Those all are not part of your expense bundle. They come out what's sometimes referred to as below the line. They come out below NOI. So after you take out debt service expense, after you take out ownership expenses, then you're left with net cash flow. Even net cash flow doesn't always represent the cash that you have. And we're going to talk about accrual versus cash accounting. But just keep that in mind. Net cash flow doesn't always mean that's the actual cash that you put in your pocket. We'll talk about it in a second. So I think that's a good place to stop here for part one of this series. We've talked about the income statement. We made it through our revenue and expense definitions. And in part two, we'll talk about the importance of the different items on the income statement. We'll talk about cash versus accrual accounting, and we'll talk about the other financial statements. I hope you've enjoyed listening in today. So as always, if you've enjoyed these podcasts and you feel like your management company could use a little advice from some of the professors here at the Apartment Academy, then go to our website, apartmentacademy.com, and click Help Me. We'll send you a questionnaire and provide individualized responses to your answers at no charge that I guarantee will offer you insights on ways you can immediately improve apartment operations. Okay, that's a wrap on today's lecture, and we'll look forward to seeing you again at part two of our financial discussion.